Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
You hear it all the time. Spoos up or spoos down. What exactly does that mean? Spoos is a slang term for the S&P 500, specifically the S&P 500 futures contract /ES. It's the world's most liquid asset. In the S&P 500, billions and billions of dollars trade hands each day. The S&P 500 represents the top US stocks, all in one basket, traded through one contract. The S&P 500's movement day to day gives you a good overview of the market as a whole and what it's doing.
If you missed the live show, here's our cherry on top weekly recap.
You know what my first concert was when I was very young. It's quite embarrassing.
Hanson.
How'd you know that?
I mean, I feel like everybody.
How did you know that?
Because who else was popular then in like the late 90s?
Oh my God,
That's amazing.
That was cringe. There it is, the song, yes.
Yes. All right, good luck, good trading. Let's go eat some roost.
Peace.
We built Tasty Trade for today's traders. See it, click it, trade it. Customized charts with hundreds of indicators. Actually see your potential profit and loss. Quickly roll to the next expiration. See gains and losses even when you roll. Cancel, replace, duplicate, or invert orders with just a few clicks. The tools, the data, the knowledge. See it, click it, trade it. Join the club, genius. Tasty Trade.
When you've got a futures contract that's in contango, what does that mean?
Futures, unlike stocks, have multiple prices appropriated to them. That's known as the forward curve. So when a futures forward curve is in contango, that means that the front month is trading cheaper than the corresponding futures back month. So you'd see that forward curve most likely looking like this in terms of prices.
And backwardation, what does that mean for futures contracts?
Backwardation is the opposite of contango. So where contango front month futures contracts are trading cheaper than the back months, backwardation is the opposite. So those front month futures contracts are trading richer than the corresponding back month contracts.
Yeah, it is Tuesday, March 11th, a little bit after 5 p.m. Central Time, the best time. You know what that means. It's time for Tasty Live's evening show, a little podcast called The Price of Truth, a show where we like to explore the incentives that govern our world. It is Tuesday here, my friends. You know what that means. We went and got the big brain. I'm talking, of course, the global head of macro here at Tasty Live, the one, the only, the incomparable Mr. Ilya Spivak. Ilya, how are you, my friend?
Beautiful day here in San Francisco. Sun is shining. Birds are chirping. It's supposed to start raining again tomorrow, but in the meantime, I am sitting in my lair looking outside and thinking I should probably be out there and catching some vitamin D's before I keel over.
Yeah, definitely. I'm glad it's good weather somewhere. I don't think it's terrific weather in Chicago, from what I hear. Anyway, it's beautiful over here too. So from 88 and sunny over here to 11,000 miles over there. I'm glad you're in great weather and good spirits, my friend Ilya. We were talking before we came on in the green room about fashion choices.
Yes.
I would say you're a San Francisco guy, and I think like the San Francisco style is kind of like, I don't know, business casual chic. You guys over there, you dress kind of casual but fly, like
I'm from
like
a different era.
subtle fly.
I'm from the early '90s, and so it's all about workwear and white sneakers for us over here.
Workwear and white sneakers. And then for you, we were joking that if you're walking down the street and you see like a mannequin in a storefront window with like an Adidas tracksuit on, it's like a moth to a flame.
I can't help myself. I can't help myself. My Soviet gene immediately activates, and although I don't wear that many tracksuits, I certainly will own one, even if it hangs in the closet, because some part of me is like, whoa, listen, we have to have it.
So what's the color? Like, what is the Soviet color choice? Is it the normal, like the black and white, and the sort of the classic look, or is it those? Are you going for those Skittle colors? That
Not
taste the
Skittle
rainbow
colors.
look.
Not to taste the rainbow look. I just recently got a dark, like maybe 6 months ago. I got a dark green Nike one.
Yeah.
That, I mean, the color alone was like, oh.
What are the stripes?
Green. Okay.
What color are the stripes? I kind of imagine the Ilya Spivak
White.
holiday. It's just a bunch of younger kids, and everyone opens up a present. It's just a different colored tracksuit.
If you take a picture of Run DMC circa like 84, that's the tracksuit direction.
All the Spivak boys come downstairs in a tracksuit to open up a present that has a tracksuit in it.
By the way, my boy is 4, right? His grandparents have bought him not 1, not 2, but 4 tracksuits already. So he is walking around a black and white stripe Adidas to the core, and he loves it. It's like he knows it's in his veins.
Oh, bro, we could have the whole Shelto conversation next, but we won't. Shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tasty Trade desktop and mobile applications. If you don't already have both, go get them. But if you want to be part of the conversation that's in the middle of your screen, this little chat box or whatever it's called on your fancy internet YouTubes today, there's only one place that you can do it, and that's over on the evil Google YouTube. So head on over there, find the Tasty Live channel, jump in the chat, start banging your skull into the keyboard or moving your phalanges and metacarpals and spoof the Google algorithm into putting us in front of as many people as possible. It is official, my friends. The deprogramming has begun. Ilya Spivak, before we get all the fun bits of conversation, let's set the table, my friend. Let's talk pure price to start off the show. S&P 500 down 3. Yes, and if you're just tuning in for the first time, it's going to surprise you after that open. This is a stock trading show. We're about to take a hard left turn. The S&P 500 is down 0.75%. The NASDAQ was down 0.25%. The Dow Jones down a little bit more than 1%. And the Russell up about 0.25%. It was a mixed day. We were sort of all over the place, on top of positive for a little bit. Vol had dropped for a bit. President Trump increased the tariff threat to Canada and threw a little bit of volatility in the middle of your trading day. But Ilya Spivak, was today day number 1 of the market trying to find some footing down here around 5,500?
So I got out of my shorts today.
Mm-hmm.
I looked at this market and said, you know what? It's had a really big run, and there's but 2 things to do here. You either roll out exposure recenter the strikes, roll out expiries, or you wait. And for me, the answer was wait, because when I started looking at, for example, my put verticals on the NASDAQ, my put verticals on the S&P, it was frankly starting to get to max profit levels. And so it didn't really pay to sit around. It was time to start to either do something to push the exposure forward, recenter the strikes to lower levels and get myself some more time, or to just get out and wait. And when I went to go to price the put verticals, the higher vol readings made it really expensive to buy puts in a way that gave you something approaching, let's say, 2-to-1 risk reward.
No way.
It's not going to happen here.
You got to go buy the tails if you want to buy put verticals right now.
Right. It's not going to happen here. So for me, that told me, okay, wait, what else is going on in these markets? And I noticed that the market seemingly, finally, today said, all right, all of this chaos is going to get the Fed to really move. And they started to significantly shift the calculus for Fed policy expectations, especially for next year.
Yeah.
Next year now looks a lot more dovish. This year looks a lot more dovish. The market now, for the first time in months, is to the dovish side of the Fed's baseline, the one they set in December. So I thought, you know what? Maybe the market is going to see CPI and take a little heart in at least for a day or two in a lower inflation number. It doesn't pay me to stick around in put verticals at max profit and see that. Let me just take this off. And maybe if there's a little bounce and the vol comes in, I'll reload.
So I think that makes a lot of sense. So you did some buying today, right? So because buying back your put verticals,
I didn't buy anything, but I covered.
To the market, it's the same thing. So in effect, you're selling puts to the market, which is sort of taking on long deltas.
Yes.
I nibbled a little bit of stuff today as well, not a ton. Doubled down on short VIX futures, bought a little upside out of the money call verticals in S&P, and then I bought some stuff that I've been messing around with. So Newmont Mining, bought a little bit more Freeport, bought a little bit more Moderna. So like the themes I've been talking about on this network, on my show on a recurring basis, I bought a little bit more of that stuff today. And it seems like, from my perspective, I was a small buyer. From your perspective, you were a small buyer. Again, you're covering, but we're doing the same thing. We're effectively buying and taking longer deltas into the marketplace, which made sense to me. I pretty much looked at the world and I go, most people are probably doing this. This is how you end up with a mixed market today. This is how you don't get a continued selling. There is a little bit of demand here for the marketplace, which is why Russell was slightly positive. Dow was kind of ugly, but everything was basically a mixed bag. You were either covering or you were finding prices that at least some people wanted to nibble on today. Do you think? Actually, let's do this. Let's game this out. I'm fascinated with this one question. You brought up the idea of the Federal Reserve. The market's pricing of cuts, and I'm sort of fascinated with this meeting that's coming up next week. Right, March 19th. We're gonna hear from Jerome Powell. We're going to basically, in the midst of all of this volatility, he's going to have to step in front of the marketplace and say no, and nothing's coming, right? So no cuts. And he's going to have to put an SEP in front of everybody. And he's going to have to speak to the idea. He's going to have to defend the idea of sort of not moving today. Yes. And either he's got to play a neutral game, Ilya, because even though cuts have theoretically started in May for the May meeting, it's still a 50-50 toss-up. It's like 57-43. It's not a guarantee. It's not really
convincing until July. Only by July do you go, okay, a cut has occurred.
So what you're saying about more and more cuts being priced into, there's still about 3. They're flirting with a 4th in 2025. But there's about 3, and they're pricing more cuts in 2026. To me, I look at it like loading the gun. It's like if Powell doesn't say the right things on the 19th, it's like the market is loading up the gun to go, okay, we're going to go find your pain point.
What did we see last year, right? The Fed is all kinds of resistant because inflation doesn't want to go its way. By April, the data starts to turn. In May, the Fed doesn't give the markets what they want. It goes, woe is me, inflation won't go down. And the market goes, oh, okay, sure. You're going to cut a lot next year. And then that becomes the story, and they put more and more and more into next year's outlook, the more resistant the Fed is. And this goes from mid-April basically until like the middle of August.
Yep. That's
You
right.
have to get all the way to Jackson Hole, where at Jackson Hole, the Fed goes, okay, and the markets go, wait, really? And by then, the economy is already turning. So when the Fed comes in September and goes, the stuff of your dovish dreams has been hereby delivered, everyone. Behold. Yeah. And everybody goes, yeah, we needed that like 2 meetings ago. The economy is already turning. Our mind is elsewhere. And there's this massive shift to a more hawkish setting already between September and November. And from November, really until January's meeting this year, you wiggle a little bit, 10, 12 basis points this way or that, but nothing much is occurring. Then you get this most recent deterioration in economic data. And again, it's the same story. The market goes, wait, I mean, you hear Powell on Friday, there's a recession risk. The economy is turning down. What? Everything's fine.
Dude, that dude is Mr. Magoo if there ever was one.
There's a lot of uncertainty.
He's the most Mr. Magoo.
The economy is fine. We get that there's uncertainty. We're not going to jump the gun on one or two pieces of data.
Yeah.
And he has to say that. Has to. Because the Fed is by definition reactive. It can't look like it's jumping from thing to thing quickly, because then you lose the credibility of the monetary authority as being a middle of the road, medium-term inflation targeting sort of institution. So he comes out and does what you might expect. We've been telling you for months we're not going to overreact. We're not going to overreact. And the markets go, haha, okay, sure. More easing into 2026.
So let me ask you. Oh, go ahead. Finish.
That's next week, I think. I think we get the same thing. I think the FOMC
you don't think he tips his hand. You don't think he starts to move towards the growth concern in order to open up the range, open up the possibilities of the cut in May. You don't think so?
Not enough.
So you think he's gonna do the same Mr. Magoo dance? The risks are balanced. We'll continue to be data dependent. Good night, everybody.
No, he'll tell him, look, well, he has to tell him that he's not asleep. So he's going to come out and go, we see. There's been consternation in the markets. We get it. And we're very happy with having lots of room to cut. And if we felt like there was an emergency, of course we would act. We don't think there is an emergency now because our variable isn't the stock market. Our variable is the labor market and inflation. And inflation isn't going down as fast as we want, and the labor market is by no means coming unglued. So if you think we're going to be out here bailing out the stock market, half of you are going to start to whine about the Powell put, and the other half is going to be happy. We're not playing that game. That's not what I do. I have two variables. I'm going to work to those two variables. Stock market wants to go down unless credit spreads are doing something that makes me afraid for the credit structure. Where is the hurry? And I think the markets are going to look at that and go, where's the hurry? Okay, more cuts in 2026.
Okay, so here's what I get it.
In other words,
I get it. So what I I hear what you're saying, and you've already answered the next question, but I want to frame the question on a mantle for the audience. So where I'm going, and you've already answered it, but where I was going was, how should I look at the Federal Reserve's sort of non-commitment that we are likely to see on March 19th? Should I look at it as a potential bringer of volatility? That that this guy's not moving, he's not pivoting, and now I've got to discount the potential that they're not actually going to move in May, and that they're going to stay at these levels a little bit longer than the market is currently forecasting? Or is it on the other side of March, I know that we've got a cutting cycle price, so I need to start positioning myself for what at least three cuts this year means for asset prices, and the market's going to start to front run that if they haven't already, and I want to start positioning towards that direction. Which one of those two directions would you lean? One, towards more uncertainty because he's opening up his range, he's not playing his cards or his hand yet, or the other direction, which is, I got a whole cutting cycle right here that the market is forecasting that I can start playing into that hand. Which one of those two directions should I lean, and why?
I think it depends which asset class you're looking at, and I think the difference matters a lot.
Okay, let's break that down.
So let's start with stocks, because that's what the people want to hear. And then we'll go to bonds, and then we'll go to currencies. I think for stocks, the anticipation that Powell is going to give everybody the healing salve next week, I think that is going to start to appear in stock markets as long as CPI complies. So the expectation is that CPI is going to come in a little. The path of U.S. economic data has been awful for weeks. It's been disappointment after disappointment. Just look at the Atlanta Fed GDP now, not as a reasonable expectation for what GDP will do. Forget that. Just look at this as a model that takes in economic data and spits out an output. What has been the tone of the data to give you the green line that you see there doing that? Obviously, bad data. So, rocket science, this is not. So I think the markets are going to get a CPI number. I think there's a decent chance that it undershoots and is lower than expected. The market, I think, for stocks is going to say, oh, goody. The Fed is going to give us something next week. They're going to tell us something. They're going to tell us that they're coming to save us. And the markets know how this works. I mean, all of the post-2008 experience was we can't rely on fiscal policy because there's a sequester and these people are fighting and we can't get anything passed through Congress because the two sides can't find common ground. The Fed is going to have to come and bail us out with more QE. We would have probably ended up with less QE after sort of 09-ish. And the initial credit market unclench. If we actually had, as we did during COVID, some sort of coordinated direction between fiscal and monetary policy, where monetary policy went big, fiscal policy went big, and COVID got smashed back as far as its economic influence. It was short, and the bounce back was hard. So I think it would have looked a lot more like that in 08, but didn't. And the market sort of understood, okay, well, if the fiscal side can't come to some kind of a reasonable growth stimulus mindset, then the Fed's the only game in town. And I think that after a week's CPI number, they're going to maybe entertain that idea. So stocks might at least stop falling. Unclear whether they get much of a bounce, we'll see, but they might find some relief. I think then the FOMC is going to come out and give them less than they want, and that might be the top on any correction because then they'll be disappointed that the help isn't coming as fast as they want it. So there's a little bit of a back and forth there in stocks. I'm not a buyer. I'm waiting for any bounce to sell into. For bonds, especially at the long end of the curve, and for the dollar, all of this looks like uniform negativity, because all of this just starts looking like we're pricing in more easing. More easing, and then some more easing, and then some more easing. And then the dollar starts to lose more of its yield advantage against other currencies. Bonds at the long end start to anticipate a more sharp, a harder hitting easing cycle downwind. And so ZB, ZN, so 10-year, 30-year, think those bonds come up.
Those bonds come up in price. Okay. So this is the most, I'm going to say this is the most interesting, but this is my biggest question, because when we started this back in September, the question was, the question was, how does the curve react?
Yeah.
And we ended up getting lower Fed funds rate, and the long end of the curve actually moved higher.
Yeah.
Through that period of time. So the red line is sort of where we started, and on each successive cut,
that was
September,
that very
November,
dovish
December,
September update.
Right. We get the lifting of the curve. Now the white line is what the curve has done since that last cut. We've basically, or since that pause, we've come down significantly. So the curve is showing you an anticipation of lower growth and sort of, I want to say, subdued sticky inflation throughout term premium in the long end of the curve. So that's what it's sort of showing you. So it's anticipating, I think, what we're ultimately going to see with this cutting cycle, which then starts.
Yeah, but look at what happens now from September in the red to November in the green, especially like 2 years out, 3 years out, right?
Yep.
Rapidly, the markets go to a less dovish setting, like by a lot. Now look at where the white line is, which is current relative to November. We are the most dovish in our 2-year, 3-year outlook since September.
Totally agree. And so the question in my mind, which I'm just putting this on the platter for everybody, but the question which you actually answered then is, when we start to, if we're going to get this new cutting cycle, how do you anticipate the long end of the curve reacting? Because we've seen in September, you started the cutting cycle, you got the long end that lifted. Then you had a pausing cycle, growth, the whole curve shifts down. Now we start the cutting cycle again. Would you anticipate a long end lift in the curve, or would you anticipate something different this time around? Because what happened in September, I would say, was probably a little bit unexpected. I don't think a lot of people expected the long end to lift to the extent that it did. Would you anticipate the same type of reaction in the curve this time around?
No, because I think what happened in September was, I think the market went, what are you bonkers promising all this easing? The economy is heating up, and we just had an election. Remember, that Fed meeting in November was immediately after the election, same week. By the time you got September's update, it was already starting to look like the election was going to go the way it was going to go. And the economy was already heating up. So the markets looked at the Fed being very, very dovish in September, which, by the way, they were calling for. The markets were calling for the Fed to be very dovish from April to August. But by the time they actually moved in September, the table was set differently. The election expectations were set differently. The growth expectations were set differently. And so when they went ultra dovish in September, the markets went, there's no way. So of course the long end has to change, because now if you're going to do all this fire and fury now, you're taking away from rate cuts we thought were coming next year. You're not going to be able to do a lot of those. You got to dilute all of this. So yields go on a big march higher at the long end. The dollar goes on a big march higher from mid-September, basically through the end of the year. The table is set differently now because growth is not only not going to give you more inflation downwind, it's looking like it'll be a minor miracle to avoid a global recession at some point in the back half of this year going into next. And so, because the one thing you can't afford to lose momentum on, the U.S. service sector, you're rapidly losing momentum on the past 2 months. So maybe you'll get the minor miracle. But for now, it's looking like you're taking away the one remaining bit of global growth that's been working. And so how you don't end up in a recession in this environment, even a shallow one, is difficult to imagine here and now. And of course, strong convictions loosely held. If the data changes, I'm going to change my mind. So at the moment, you read that differently. You get weakness and you start to say, well, there'll be more easing now and there'll be more easing later. The whole curve shifts. The base for the whole curve, from the floor from which you start to add term, premium, et cetera, just comes down for everything.
Got it. So your expectation is that we'll continue to see this, the yield curve will normalize, so that front end of that curve will come out or move towards away from inversion territory. We'll get to a more normalized shape of the yield curve, and it will also shift lower. Yields across the curve will move lower as we get into this cutting cycle. That's your baseline expectation, which means you probably are cool going long the 10s, long the 30s,
and I am
maybe even long the 2s. Which one of the, do you have a preference on which end of the curve you'd like to be long? Because I got to imagine those 2s got to be ripe for a rally, given what you believe could be possible, no?
I mean, they've kind of seen it already. So if you look at what's been going on here, the 2s have started to go up from about the middle of February when we got this most recent growth spook. When you look at what's happened at the 10-year and at the 30-year, they started to move a month earlier than that. So you started to see the long end already shifting as of January. The PMIs started to really warn you in January. You and I talked about it on this show. I said, hey, those January PMIs, they don't look good. And it's 1 month's data. Let's see if we get a second. And if we got a second, that would start to look scary because two points start to make a line. And they don't quite make a line, but they start to make a line. And people start to go, okay, well, this is not just a one-off. Already in January, the long end started to bottom. Yields started to come off. So, and the 2s are catching up now. I generally like to play the front end of the curve through currencies because it's more liquid and easier to manage. And so to just move the dollar rather than the 2-year, since I'm expecting that we're going to get lower yields across the board, I already have, I'm back in a TLT call vertical, and I've held it now for about 2 weeks. That's the second time I dip my toe in here. I initially started buying in mid-January, got spooked out in early February where there was that little dip, and I've re-entered as of about 2 weeks ago. So I'm long a TLT vertical. I'm certainly not beyond adding into it, and I am in lieu of being long the front end, I am massively short the dollar, and I've been holding short the dollar for a long time now, for about a month and a half, 2 months. And that's against the euro, the Aussie, the Canadian dollar, the yen, the pound, the whole thing.
So let me actually, as you were talking, you kind of you helped basically, I think something dawned on me. You helped frame something for me. So let me run it back to you, and then I'm going to go asset by asset class, because this is how we do the show. We start with your baseline assumption on yields, and we take your opinion on yields, and then we spider out throughout the rest of the asset classes. But you just tripped something, and I want to pull this thread. You had said at one point that like Jerome Powell at the end of last year was sort of like this judo master. He was using the market's momentum against it, which I thought was just like the perfect anomaly for what was happening. And some part of me just realized that my question to you was, do you start to price the cuts that are coming or play the uncertainty because he's going to be coy about this because he doesn't want to telegraph sort of the cut package or when he's going to start it? And I realized it depends on the market. To your point of the judo master, it depends on what the market does. So if the market starts to price the cutting cycle, then that actually gives them more time. So that you're getting the liquidity on the front end, and you don't need to go early. And then reflexively, if the market then does not give them the benefit of doubt for pricing in these cuts and the easing, then they need to actually move forward. So in a way, the fact that the market is currently pricing these cuts in a weird little way, it gives them the range to see whether or not they want to go in May or June. So I actually already have my answer, do I not?
Yeah, I mean, they're on a different timeline. One of the most useful things that I have learned in my years in currency markets before I branched out to other assets in a sort of a bigger picture macro view, and really what enabled me to do that was to understand that the cost of money typically matters more than anything else, because that determines whether the markets want to lay out any kind of risk or not. And if they do, then you go find where they want to do that. And if they don't, it's a whole other thing. It's liquidation. And it doesn't matter. Sectors don't matter. Asset classes don't matter. Look at gold. Yields are falling and the dollar is falling, and gold can't go anywhere because people are liquidating. They're going to cash. It doesn't matter. They're selling what's not nailed down. So you learn that, and then you learn, as you realize that the cost of money typically matters more than anything else, and that's a starting line for almost everything else, then you realize the markets and the Fed operate on different temporal lines. The Fed thinks in terms of quarters and years, and the markets think in terms of days and weeks. And when there is and the Fed is very well aware of the markets, and the markets are very well aware of the Fed, and there is a dance. And if you can get a good sense of the dance, there's a lot that you can glean just from that.
Amen, bro. Amen. All right. So then I'm going to ask the question in the way that our friend Laid Back Trader asked in the chat. You sort of gave your view of the world through bonds, which explicitly or implicitly tells us your view of sort of growth and risk on, risk off. But let's unpack it and let's make it explicit.
Sure.
So the way that Laid Back Trader asked it, so is it risk on or risk off, and what assets would you rotate into? So let's make it explicit. It is risk off. Explain why you feel that way, and then how you sort of navigate this next couple of months from your point of view. I'm not necessarily agreeing. I do agree that it is risk off, but I'm being opportunistic to accumulate into risk off. So that's the way I think. Right. If you want to trade with momentum and just be on the right side of a binary pick, I would probably agree with you, but that's not the way I sort of deploy capital. Anyways, go ahead, Elliot.
Yeah. So I deploy capital in different ways for the kind of opportunistic few weeks at a time, 45 days to expiration type of tactical exposure. That is the trading side of what I do, as opposed to the set it and forget it longer term investing that I do. I think it's very clearly risk off. I think the stock market is telling you that in no uncertain terms. If the S&P is kind of your barometer for the market's appetite for risk, you can very clearly see what's going on. And you can also see that it's not going on for flimsy reasons. It's not going on because they found Jensen Huang in some sort of compromising position, and now, oh no, NVIDIA is going to have a new CEO and everything is going to fall apart. No, it's not some sort of nonsense. Economic growth is actually suffering, and you can see it in the data. And this was always the risk. We've talked about it for 6-9 months, that Europe is anemic, China is anemic. That leaves just the US, and in the US, the goods side of the ledger is anemic. It's the service sector in the US then that powers global growth, and everything else is getting, by hook or by crook, dragged along. And you lose the US service sector, you've lost the game. You've crapped out. There's recession. So what we see that's so troubling in the data is that is starting to occur. And the reason that it's starting to occur, if you read what ISM is saying from their surveys, what S&P Global is saying from their surveys, this is of businesses and why they're so upset. If you ask consumers, whether you're the University of Michigan, that's one benchmark survey, a conference board that does another, you start looking at all of this other data that's starting to fall in line. It's about uncertainty. It's about policy uncertainty. Powell said it on Friday also. This is not, at this point, much of a debate. The issue is policy uncertainty. And if the markets were to get clarity, whatever the policy was, doesn't matter what the policy is. The markets just need a forecastable path forward where they can say, over the next 12 months, let's say tariff policy is this. Okay, let's value assets for that. There'll be some sort of a shuffling of money from pile A into pile B to reflect what that is going to mean. On we go. I think the problem for the markets here is they don't know what the path is, or don't feel like they do. And so there's uncertainty and a sense of, well, if I don't know, I'm not going to lay out risk. I'm just going to take the money and wait until the dust settles and there is certainty and deploy risk thereafter. And I think everything that you're hearing from the administration is there's going to be a detoxing period, apparently. There's going to be a transition, this, that, all of which signals they're not looking to get off their path, at least here. And you've had some back and forth. Maybe we're not going to have those electricity tariffs from Ontario or this or that. But the thrust of the administration's policy direction, that is to say, to come out there, be chaotic on the negotiation of tariffs, ostensibly to set the stage for a renegotiation of USMCA, which is what, to me, all of this is really about. That and to exempt USMCA covered goods out of the tariffs tells you what they want, which is actually to include more goods into the USMCA and thereby have a bigger free trade zone, not a smaller one. I think that gets lost a lot, that the administration, if you read the tea leaves, seems to want more free trade, not less, lower tariffs, not higher. But it wants to get there by waving around a sword and not by inviting people into friendly conversation, because for whatever reason, it feels like it can get a better deal by hulking out. So at some point, this is going to ostensibly give way to that negotiation occurring, like it did with the USMCA and its emergence out of NAFTA. So at some point, the fire and fury will ostensibly end, if that's the model, but not yet, and they're not signaling that the time is now. So as long as the fire and fury continues, as Chris likes to say, the beatings will continue until morale improves. So that seems like where this is going. So I think the market is going to be unhappy. And I think now they've kind of seen through the looking glass of you can't just blindly buy every dip. And now people are getting nervous. So I think there's more to this sell-off. I think the bias is risk off. I think you do get a bounce in stocks maybe between now and next week's Fed meeting, or at least some kind of a deceleration of the sell-off. And to me, that's an opportunity to be a seller when vol gets a little bit cheaper and the pricing gets a little bit better versus now. I still want to short. I just don't want to short here. In fact, I took my shorts off here. I'm looking at 5,700 S&P, 5,750 S&P to go, okay, that's enough of a bounce. Let's sell them again.
I am a little bit less bearish than you. I'm still in this sort of, I'm not convinced. You know what I mean? I'm not easily spooked. I'm not convinced that we're out of a sideways trading range. We just gotta use a higher vol number, which means the range is wider. And I'm gonna tell you why. I think you are right. I think there are headwinds to global trade and to global growth. But I think you and I would agree, we've been decelerating in growth for like a year now, and like nobody's noticing. And now you're sort of putting
globally, yes. U.S., yes. No, but globally, yes.
No, even the U.S., we've come off of 4% growth down to 3%. So you're still
good GDP numbers that are kind of slower rolling.
And I'm just saying we're decelerating. Yes. I'm not saying we're going to slow down, but we've been decelerating for a year is my baseline point. But I guess where I'm going is there are headwinds and tailwinds. You know what I mean? There are competing forces. At all times, there's inflationary forces, deflationary forces. There can be bullish catalysts along with bearish catalysts, and ultimately, it's just the net effect. I do agree with you that what's happening in global trade, the uncertainty that surrounds that trade, and the forward planning that CEOs and boards and marketing departments and all of that have to do in the face of the uncertainty, regardless if you slap the tariffs on or not, or a 30-day pause. If you're a responsible, prudent business person, you're going, what's my worst case scenario, and how do I optimize my business so that I can maximize margins into my worst case scenario? And if I'm going to be surprised, I'm going to be pleasantly surprised because I planned for the worst. That's what's happening in my personal opinion right now. But I think like the opposite side, and that's the hope, the opposite side is that looser monetary policy can somewhat or will play some sort of counterbalance to what's happening on the fiscal side.
I think that's what they're hoping.
I think that's what they're hoping. And while there is some cuts in government, everything that I've seen so far is adding $3 trillion to the deficit. You know, we're adding to the deficit. We're cutting some stuff, but like, we're not necessarily going.
I don't think there's a fiscal headwind. There's just uncertainty.
Exactly. So I'm not so certain I should run for the hills yet in sort of how I think about risk. And maybe I'm wrong. Maybe I should be on your side of the train, and the market's going to have to beat me into submission. But I'm playing this just like we're going to rotate down. 5,500 might be my new fair value instead of 6,000, and now I'm playing plus or minus 300 instead of 6,000 plus or minus 200. And I think that's the world that I'm playing, and I'm only offering that as a different potential point of view or competing alternative.
No, that's very fair
to your sort of world that you're setting up. No, it's
very fair, because I think if you're laying out capital for a longer period of time, and you ask me, do you think that the view on the S&P 500 over the next 10 years, up or down, unmistakably up, without question, in my mind? So in my longer term exposure, I'm long, but I'm not tactically doing adjustments to that exposure every month or two.
So you're short dollars here. you're okay leaning long bonds, and then how else do you express your opinion, and let's start with that. The next question will be, what do you look for in order to start to change your opinion? But let's start with, outside of short dollars and outside of long bonds, how else are you sort of playing this?
So I'm waiting for stocks to give me the next opportunity, because I don't think the washout is done. I think we're going to get a chance to sell at better levels and then set a lower low relative to this low, and then we'll see.
In other words, you're hoping for a dead cat bounce, which will then give you an opportunity to get short again into a lower low.
Yes. So that's one thing. That's what I'm doing on the stocks side. And here it's NASDAQ, S&P, Russell. And the other thing I'm looking at is crude, which is sitting at support, long-term support. If you're, again, thinking tactically, so like in terms of weeks and not years. And if there's a real growth scare, we're going to crack that support. But if there is some sort of a relief in sentiment, then maybe we bounce. And maybe this reluctance of crude to sell in the past several days, it's kind of idling at these lows that we saw from September, October, November. There's like multiple bottoms there. You can see there's that choppy range, and we're sitting right on it. So if there's a bounce, I want to be a seller of oil. Much like I want a dead cat bounce in stocks, I want a dead cat bounce in oil. Gold. I don't really like silver because silver has a little bit more weighing toward risk sentiment. I do like gold. I think it's really interesting here that gold is doing nothing at all, and that when the liquidation gets really violent, it sells off also. But we're basically locked now, where on the one hand, people are trying to divest of everything and raise cash. And on the other hand, as they do that, yields come down, which helps gold. The dollar comes down, which helps gold. So gold is kind of in no man's land here, looking for what is going to be the dominant catalyst. And I think if you ultimately land on it's not the end of the world because the Fed will save us, and I think the market wants that to be the answer, hence the dead cat bounce potential, I think you might get a breakout in gold. Because if the markets go, it's okay, the relief valve will be lower rates and a weaker dollar, gold goes unmistakably higher. As long as the markets believe the relief valve is going to work. And I think for now, they are likely to do that. I don't think they're going to go holy moly credit spreads just yet.
Holy moly. Bro, the way you personify the market is hilarious. So then the area we haven't talked about, is what you think about if you don't like U.S. markets and you're looking for a dead cat bounce in order to short U.S. markets. And I think it seems like you're doing that indiscriminately. I don't think you love the Russell, hate the NASDAQ, or anything like that. It seems like you'll take all comers in terms of fading risk assets in the majors. What do you think about emerging markets or just international markets in general? Would you be an incremental buyer of any other country, region, or continent outside of the United States?
I think right now, one of the curious things that's happened.
And sorry, the reason I'm asking this is your view on the dollar is very bearish. And so in many people's view would say, all right, well, if you're bearish on the dollar, that will have this particular impact on emerging or developing markets. Therefore, so there's sort of this correlation. And so I have to ask the question, well, if you think the dollar's going to get weak, what do you think about international markets? Go ahead.
It's very important not to confuse the state of the economy with the direction of the stock market, with the direction of the currency. because those three things don't necessarily rhyme. And what we're seeing right now is some of it rhyming. So the direction of the economy is obviously a level of concern. On that basis, we're seeing much more dovish expectations for Fed policy than we saw even a month ago. And not surprisingly, that has kicked the dollar squarely in the teeth. It's also helped, and this is where you get the very significant difference between how the euro looks and how, let's say, the Aussie dollar looks. The euro looks much, much stronger. And it's because what you've seen is the dollar is still the liquid cash of choice in a liquidation. So if you look at what's happening with those currencies that are the most sensitive to what's going on in stocks and sentiment more generally, the dollar is holding up much better there. And this is why you can't say, oh, well, U.S. growth is in a bad place. Money is going to rotate out of the U.S. to other places. This is that lunacy that the markets were entertaining in the first half of 2008, where everybody ran around going, oh, well, the U.S. will just have a recession and mortgage crisis, but everything else is going to be fine. The world will decouple from the U.S. Put the crack pipe down. This is the largest consumer market in the world. And Europe and China, the other two major engines of growth, depend for a large part of their growth on selling into the U.S. market. If the U.S. has a recession, it's bringing down everybody. Everybody's going. So this is why the dollar stands to benefit in ultra risk-off conditions. So you can't necessarily say that what stocks are doing and the dollar is doing and the economy is doing are connected, because if the economy really falls off a cliff and stocks crater, chances are you get a stronger dollar, not a weaker one. So you get into a situation then here where you want to see rotation. And what rotation would tell you is the Fed is going to be successful. It's going to cut rates. That will save the economy. And the release valve will be lower yields. If the markets believe that, then yes, you get a weaker dollar, you get lower rates, and you get stocks outside the U.S., in particular in Europe, not in China, but in particular in Europe, looking better and starting to take some of that money. But if there is a broad-based global recession, run for the hills, hair on fire situation, like we saw during COVID, like we saw in the 08 crisis, at its most extreme, those are crescendos. You build into something like that over quarters. Then, yeah, you get a dollar that's stronger against all odds. So and then you don't get rotation. Correlation goes to one, everybody's selling everything. So what you're looking at most recently, if you look at EZU, the ETF tracking European markets, FEZ is another one that's a little bit cheaper that I like. If you look at EWU, these markets are not rallying with the US getting weaker. They're coming down. This is liquidation. They're not coming down as much, but look at what's happening the past week or so when US markets really hit fever pitch. Look at EWJ, Japan's index. It's lower. Look at what's going on in China, and the mainland ETF, which is ASHR, hasn't gone anywhere in forever. But FXI, which has listings in Hong Kong on it, all of those are Hong Kong names, that's higher. And why? Well, when you look at Stock Connect flows, it seems to suggest that all the money isn't going from south to north, that is optimism in a mainland rebound. It's going from north to south, that is money fleeing China through the escape valve that is Hong Kong. And so what it's looking like right now is that the market isn't prepared to believe in rotation. But again, I think there's a dead cat bounce in this thing. So I think you get some rotation, maybe over the next week, but I'm not sure it's lasting.
I just, I guess I'm trying to understand how so I view things on an absolute and a relative basis. On an absolute basis, for the last several weeks, U.S. markets are moving lower. And I can point to a decent number of international markets that are, on an absolute basis, higher than when we started the U.S. sell-off. And on a relative basis, even if you're flatlining, on a relative basis, you're outperforming the U.S. markets. If you were long that market and it goes sideways and you're short the U.S. market, you're doing okay. So I'm having a hard time understanding the framing that international markets aren't doing well in this last couple of weeks to couple of months relative to U.S. markets.
Well, couple of months, maybe, yes. But if you look at where
even the last couple of weeks.
Well, the last couple of weeks, it's a very different story. Look at what you have from, let's call it the Nikkei. All right, let's go to EWJ.
Sure.
And obviously, this is in U.S. dollar terms, so discount that, right? This is not in yen terms. And because it's not in yen terms, the sell-off in the U.S. dollar is flattering this a little.
Okay, I see what you're saying.
But if you look at what's going on in the Nikkei, what you've had happen from shock of shocks, late January in the Nikkei, is you've had a sell-off of just about 11.5% as of today's low. If you look at what's happened in Europe as of the peak at the end of February, right as U.S. markets started to roll over about in, let's call it the 21st, 22nd, the peak in Europe seems to be March 3rd. For the Euro stocks index, you've had a sell-off of about 5%, 5.2. If you look at what's happened in the UK, the peak there is, again, March 3rd, and you've had a sell-off of about almost 5%, 4.8. Now, again, when you look at the ETFs, the dollar sell-off is flattering them because they're in U.S. dollar terms. But what you've had is a sell-off in the baseline indexes, and it's because people are just selling risk.
Okay, got it. I think that definitely helps, and I appreciate the nuance, which is why I always ask you the question, because your brain is always working on a level that I've got to sort of acclimate myself to. In fairness, I think for the people who are watching this show, the high likelihood is that they're focused on a dollar return. So when I talk like international markets outperforming on a relative basis, I think that's probably a fair assumption. But to your point, to be
very important question, why?
Yeah, to be very clear about what's happening and what's built into that return, I think is important. That level of nuance is important.
Well, and whether you want to believe that there is and this is what I think is so important. It's not that they're not outperforming in dollar terms. Of course they are.
Yep.
That's not the question. The question is, do you believe that investors are out there saying a bet on multiple expansion in Europe is what I believe? And the answer is no.
Right. That makes sense. That makes sense, my friend. Well, then let me ask you, since the last time we talked, a lot has happened in Canada. I'm going to ask you a super open-ended question.
Yeah.
It's a super open-ended question because I more or less just kind of want to see your open-ended thoughts on what you think is happening in Canada, not only with Mark Carney, but with the escalation in tariffs and the tit for tat, the back and forth that's happened with Ontario over the last 24 to 48 hours. There's a lot that you could cover if you've been following all of it. So I'm going to leave it open-ended and let you go with it where you will. What do you think about what's happening between the U.S. and Canada right now?
So Canada is obviously in a state of transition, right? Justin Trudeau was terribly unpopular as a prime minister for very obvious reasons. His own deputy prime minister and finance minister quit on him and told him, listen, you're out here twiddling your thumbs. We have a trade war coming up. And instead of getting us ready for a renegotiation that's substantive, like we had with the USMCA and its emergence out of NAFTA, you're over here doing God knows what. And he had to resign in January because there was just no way for him to continue. We've now had the new prime minister, and the Labour Party, which hasn't actually activated a general election, they get to pick their leader. That leader becomes prime minister until there's an election, and we'll see if this new leader, who is Mark Carney, the former governor of the Bank of Canada and the former governor of the Bank of England, if he is, well, now that he's prime minister, he's going to have to activate an election. And we'll see if he goes the Theresa May route, basically says, I need to do this fast and secure a mandate, or if he's going to wait it out. Ostensibly, I think if you're Carney here, maybe you try to go sooner because you want to get this USMCA negotiation going, and because the polls in Canada have shifted dramatically. Really, it wasn't about the Liberal Party. It was about Justin Trudeau. Because before he at least the polls seem to suggest it, because before Trudeau resigned, the Conservative Party of Canada's leader and their candidate for prime minister,
Pierre Poilievre.
Exactly, Pierre Poilievre, he was the next prime minister of Canada with almost perfect certainty. He was a shoo-in. The polls weren't even remotely close. Now that Justin Trudeau has resigned, and back in January when he did, the polls started to dramatically shift. And even
I think
back
the context. I think the context there, though, is that the aggression, the seeming economic aggression, the tactics used in this negotiation seems to have, they say like war.
They created a rally around the flag effect.
It tends to be good for the incumbent president. It seems like that was the case there as well. That there seems to be.
Well, sure. I mean, sure, and frankly, if you're the current U.S. administration, perhaps you ought to have thought about a textbook rally around the flag effect if you wanted Pierre Poilievre in there, who you have greater affinity for, and with whom you have a relationship, and where you might have had a better negotiation. Maybe you should have set him up for success.
Right.
But no. No. In any case, it's pretty locked right now. It's about a 50-50 shot. And the Liberal Party could have picked a different candidate. They had that outgoing deputy prime minister that decided to scorch her boss, Chrystia Freeland. But no, they picked Mark Carney. And Mark Carney is somebody with tremendous crisis management pedigree. He steered the Bank of Canada very successfurely.
Nothing like a central banker. Nothing like a central banker to come in and lead the country. That's what we need.
I mean, listen,
more central bankers.
Mario Draghi was a great example in Europe for when you're really in trouble, get you a crisis manager from the central bank to inject a level of safety into the conversation. And boy, did it work for Italy. Because Mario Draghi had great credibility after what he did at the ECB, and he stabilized what was a very precarious situation in Italy. Then to hand off to now, Italy looks like it is in much better shape. The situation that Giorgia Meloni inherited was orders of magnitude better than if she had inherited, let's say, directly from the Renzi government, for example. So the situation in Canada now is the Liberal candidate will be a hero of managing the Bank of Canada during the mortgage crisis and the '08 crisis, and then again a hero of the Bank of England that navigated it through the Brexit turmoil and didn't break the markets and navigated that carefully. This is a very safe pair of hands, is the pitch. This guy knows a crisis and can negotiate with the US and get results because he had to do quite the dance between the Eurozone and the UK. And then he had to do quite the dance in '08 because the whole world was melting down. So this will be very interesting now, what happens in Canada next. I was kind of hoping Carney wouldn't get picked on the Liberal side this time because I think that the Conservatives still have a little bit of
You think he's in a weak
advantage.
position, and then you think
I would have
he could
rather
come along
him.
the next
I would have
round.
rather him win an election later because I think he's
Right.
excellent. But he's gonna have to run to some extent on the Trudeau record, not because it's his record, but because it's the same party. And
I think the central bank
that might hurt him.
I think the central bank has like an influencer program, kind of like how, just people that are influencers that have like promotional tags, sign up for this, use my promo code Ilya. I think you're like a central bank influencer that's been sent here from like the global
They've
central
been the
banks
competent policy makers for the past 20 years.
to spread central bank propaganda to
fiscal authorities
to the masses.
Fiscal authorities have been completely inept for the past 20 years, and all of the crisis management has fallen to central banks, and they've done reasonably well at it. The ECB safeguarded the euro when push came to shove. The Bank of England, under Carney, safeguarded the UK when Brexit really hit the fan. The Fed, under Bernanke, bailed out the entire world economy out of another great depression by being clever in a credit crunch. On and on and on and on it goes. They're not perfect, but if you wanted competent policy making for the past 20 years, it's a central banker that was doing it.
Let me ask you this question. We rerun the 2028 election, okay? But there's three parties. Kamala's still the front runner for the Dem Party. Trump is still the front runner for the Republican Party. There's a new third party, and Ben Bernanke is the leader. So you can vote for any of these three. They all have a 30-30 shot in the polls, so you can't say it's a wasted vote. Of those three, you can vote for any of those three in the 2024 election. Who does Ilya Spivak vote for?
Of course I'm voting for Ben Bernanke. Are you kidding me? Are you kidding me? Of course I'm voting for Ben Bernanke.
Chat, what say you? I guarantee
there is
if we were looking for engagement, we just found it.
Deserves a statue in his hometown as an American hero.
Jesus Christ, bro. Jesus Christ. I don't even have the energy today to do this with you. I
Come at me, bro.
I don't have the energy in 15 minutes left in the show to do that one, bro. Earlier at the beginning of the show, in the chat, somebody goes, Ben Bernanke ruined the economy, along with Janet Yellen or something like this. And that's like the level of feeling out there. Ilya Spivak believes he should be the leader of the country. A statue should be built for him. And I feel like I think when they gave him that Nobel Prize in 2022, I think you think it was well deserved.
Of course it was well deserved. Man is an American hero.
I love you to death, dude. Help me out. Let's do some nuance here in the dollar then. How should I think about the CAD, the Mexican peso, in the face of what's happening with these negotiations? So take it from, you just gave me the background of what's happening in Canada. How should I be thinking about the Canadian dollar given that backdrop you just gave me? And let's do the same thing with the Mexican peso, /6M.
Sure. So I think the Canadian dollar has been very unloved in this environment.
Yes.
It's been one of the places where you've really seen a currency struggle despite the dollar's weakness. I don't really buy that it's done bottoming. I'm still a little bit long, pretty much at these levels. And so I'm looking at and I mean, I've had this on for a while. And so it hasn't really worked yet, but it hasn't really shaken me out yet. I think, going back to what we said earlier in the show, I think the markets are going to come around to the idea that the essence of all of these strong arming tactics isn't just mean-spiritedness for its own sake. I think this is a negotiation. I think where people want to arrive at the end of the negotiation is a bigger free trade deal between the U.S., Mexico, and Canada, not a smaller one.
Yep.
And I think that's good for Canada, and I think it's good for Mexico, and it's good for the U.S., but I think that makes the Canadian dollar look cheap. It makes the peso look cheap. I think there's a lot of fear around the U.S. doesn't get where its bread is buttered, and I think the U.S. gets it just fine.
100% agree with you.
I think when you look at what happened with the NAFTA renegotiation, everybody was setting their hair on fire going, you're going to get rid of NAFTA, the most successful trade agreement in the known universe?
Not everybody. Just that was the media narrative. Yeah, I agree.
The markets were fearful. I could care less about the media narrative.
That's true.
The markets were fearful. You know this about me. I don't pay attention to the media at all. I don't pay attention to the right side media. I don't pay attention to the left side media. I look at economic data and the price action as filters for what I'm doing in markets. I could care less what anybody's saying.
I see you as a 60 Minutes guy, though. I see you as a guy who reads The Economist and watches.
I read The Economist
faithfully.
I don't really watch 60 Minutes unless it's somebody interesting on. It's not a regular thing I watch, but I read the Economist. Yes.
Yeah.
I think The Economist is sane and sober for the most part.
So I agree with you 100% on the USMCA. I think this is a tactic to drive a renegotiation of the North American economic bloc, but I also believe that that's only that's phase one, and then that being done as a precursor, as a predecessor to then going and looking at China going, okay, now it's your turn and we need to talk. So I think we get through this USMCA renegotiation, which is going to be bumpy. But even if there's some reprieve, right, we get to the other side of this and we go, okay, we renegotiate this. Well, that only gets us to the final boss.
I think it's a kind of Monroe Doctrine kind of a thing.
Correct.
That's starting to emerge, where we're basically saying we are the United States and this is our hemisphere. He who comes into our hemisphere must understand, in true Monroe Doctrine fashion, you can do business here, and we have no issue. But don't think you're going to set up enclaves of influence here, because you're not. This is our swimming pool. You can swim in the pool, but you cannot stay. Take the floaty, go back home at the end of the day. And so I think the renegotiation of the USMCA is very much step one. I think we want a deal with China where China understands that they need us. We need them, but they need us much more than we need them. And I think to make that argument, you need to have a very robust free trade agreement in the Western Hemisphere that then envisions that South America starts getting a lot more development and becomes the new China. And I think I think the Panama Canal thing is adjacent in that conversation. again, I think people need to start to look at the first administration's tactics. And yes, the fire and fury now is much louder and sharper and more volatile. But last time it was more volatile relative to the thing that came before. The question is, what is the volatility aimed at? And I think it's aimed at a corralling of people into deals. I think this volatility is aimed at the same thing. And I think what we're trying to do is build a Western Hemisphere economic zone that collectively then, to your point, turns to China, turns to Europe and goes, okay, now let's have an understanding about how your regional hub and that regional hub and our regional hub interact. But don't get it confused. This part of it is ours.
Yeah, I agree. But my bigger, broader point is that if there's sort of some relief rally because, oh, great, we've got this MCA renegotiated and all this sort of craziness or uncertainty that's built around what will Canada do, what will Mexico do. I think that you have to be careful about getting too excited because that only means that you're moving on to a bigger level.
In the Canadian dollar, no.
Oh,
so
yeah,
I think yes.
I agree with that.
I think yes, the Canadian dollar gets a rally, Mexican peso gets a rally, but don't go thinking that the problem is solved in stocks. It very much is not. I agree.
Right on, bro. All right. I can't believe we're going to do this. But I don't know. When you trade the Canadian dollar and Mexican peso, I know a lot of you're doing it directly in currencies themselves, but do you ever trade the futures?
The futures? Oh, yeah. Yeah.
And then do you ever trade the options on the futures in these pairs? So Canadian dollar options, are they decent?
Because there's not options on the micro contracts, and I like the smaller size. So I like to be more nimble with my risk management, and so I like the M6 contracts, not the 6. And there's not options there. So I'm just an outright buyer and seller of the M6 futures, be it M6E or M6C or M6A, whatever it is.
Right on, my friend. All right, Ilya Spivak, always fun. I didn't talk to you that I was going to the Canada route, and you had a beautiful, I think, lay of the land there. I appreciate that, my good friend. If the people want more from you and you've given them no reason not to, can you tell them where they can go, my friend?
I am, as ever, all over the network. Overtime and Macro Money are there Monday through Thursday. We're here on Tuesday. We're also talking to Tom at the open of the week for First Call on Sundays, you and I. I am on with Chris for Futures Power Hour Mondays and Fridays. So I'm all over the network. I'm also writing for the News and Insights bit of tastylive.com. I'm commenting at Ilya Spivak on Twitter and on Blue Sky. So all of your Ben Bernanke hate, if you really want a response, that's where it goes. You
kind of look like you could be like Bernanke's grandson or something.
I mean,
you know what I mean?
I think we come from similar stock, but I was there during the 2008 crisis and trading markets. I was watching it live. I had exposure on. I will not be moved on this. And if you really want a response, let's go. I do respond when people reach out on these platforms. Ditto for my YouTube comments. So, if you wanna go, we can go.
You're supposed to tell them where they can find me, not challenge them to a duel. If you want to find me, at Victor Jones on Twitter, the O in Jones is 0 because I like to be difficult. Ilya, it's a pleasure and an honor to be able to chop it up with you once or twice a week, really, but once a week here on The Price of Truth. I wish you the best. My friend, for all of you risk managers out there, I wish you the best as well. I will see you back here tomorrow, same time, same great network with a conversation with Chris Vecchio. Hit the like button on your way out the door. Subscribe to the channel if you haven't already. Follow your good friend Ilya Spivak on Twitter as well as on Blue Sky, and go haggle the shit out of him about his views on Ben Bernanke and that Nobel Prize. We'll see you back here tomorrow. Peace, everybody.
Peace.